Right before every market crash, there's a moment. A moment where every investor, from the Wall Street veteran to the guy checking his phone app at lunch, thinks the exact same thing. Should I just sell everything right now? Because nobody wants to be that investor, the one still holding when the market drops 20, 30, even 50%, watching their portfolio bleed red while everyone else seemingly got out in time. But here's the problem nobody talks about. Trying to time the market is like calling a Hail Mary on every single play. Sure, it works occasionally. Highlight reels are full of them. But build your entire game plan around it? You're not playing smart football. You're just gambling with a helmet on. And in investing, just like on the field, gambling with your game plan is how you lose seasons, not just games. Let's be real about what a market crash actually feels like from the inside. It's not just numbers dropping. It's red charts bleeding across every screen. It's breaking news anchors with grave faces. It's your group chat blowing up. It's that sinking feeling in your stomach that whispers, "Get out before it gets worse." Your instincts are screaming at you, and those instincts feel completely rational in the moment. But here's what history keeps showing us, over and over again, no matter how many times the market crashes and recovers. Most investors who try to sell before a crash end up making one critical mistake that costs them far more than the crash itself. They miss the recovery. And missing the recovery is how you go from a temporary loss to a permanent one. Here's what makes this so brutally difficult. The stock market does not send you a calendar invite before it drops. There's no injury report, no scouting update, no advance warning that says, "Hey, sell everything this Thursday at 2 p.m." And it absolutely does not tell you when it's about to bounce back. Some of the biggest single-day gains in market history happened within days, sometimes within hours of the most devastating sell-offs. We're talking massive rebounds that happen fast, quietly, and without announcement. Miss those days because you pulled your money out in panic, and your long-term returns don't just dip, they can collapse dramatically. JP Morgan ran the numbers on this. If you missed just the 10 best trading days in the market over a 20-year period, 10 days out of roughly 5,000, your returns were cut nearly in half. 10 days. This is why even the most elite professional fund managers, people whose entire career is reading market signals, consistently struggle to time the market correctly. Because it's never just about getting out at the right moment. You also have to get back in at the right moment. Two perfect decisions back to back under maximum pressure. That's where most people fumble the ball, not on the way out, on the way back in. Think about what you're actually doing when you try to time a crash. You're the quarterback, the defense is blitzing hard, pressure coming from every direction, red charts everywhere, panic in the air, and your instinct is to launch the ball downfield blindly and hope someone's open. That's a Hail Mary, and smart quarterbacks don't run their offense on Hail Marys. When a real blitz comes, elite quarterbacks don't abandon the playbook. They read the defense, they make quick, calculated adjustments, they protect the ball, run smarter plays, and trust that their long-term game plan is built for exactly this kind of pressure. Selling everything the moment the market gets scary is the investing equivalent of scrapping your entire offensive strategy because the defense looks intimidating. Sometimes the desperate play works, but base your whole season on it, you're not building a dynasty. You're just getting lucky once in a while. The investors who win over the long haul aren't the ones making the flashiest panic plays. They're the ones who refuse to abandon their game plan when the blitz arrives. So what does smart positioning actually look like when volatility hits? Experienced investors stop asking, "Should I sell everything?" and start asking a much better question. How well prepared is my portfolio for what's coming? That's a completely different play call, and it changes everything. It means holding some cash on the sideline, dry powder you can deploy when real opportunities appear after a sell-off. It means owning defensive stocks in sectors like healthcare, utilities, and consumer staples that historically hold steadier when the market gets rough. It means not being overexposed to high-risk, high-volatility assets that get destroyed in a downturn. And above all, it means thinking in seasons, not single plays. Here's the part most financial media never tells you clearly enough. The biggest risk during a market crash is rarely the crash itself. It's your reaction to it. Selling in fear locks in losses that might have been fully temporary. Sitting on the sideline too long waiting for the perfect moment to get back in means missing the early stages of the recovery, historically the most explosive part of any market rebound. This is the single biggest reason why the average retail investor dramatically underperforms the market over time. Not because they chose bad stocks, not because they lacked information, but because they made emotional decisions at the absolute worst possible moments, selling at the bottom, buying back at the top. Emotion is the penalty that keeps getting called, and penalties lose games. Pull up any long-term market chart in history, any of them. You'll see crashes: 1929, 1987, 2000, 2008, 2020. Every single one looked catastrophic in the moment. Every single one felt like the game was over, and every single one was followed by a recovery. Investors who stayed disciplined, who kept their starting lineup on the field even when the scoreboard looked ugly, were historically rewarded, not because they ignored risk, but because they understood something crucial. Downturns are not the end of the game, they're just a difficult quarter, and difficult quarters are won by teams with the composure to stick to their strategy. So instead of trying to predict the exact snap count when the market crashes, redirect that energy towards what you can actually control. Your asset allocation, how your portfolio is divided between stocks, bonds, and cash. Your risk tolerance, how much volatility you can genuinely stomach without making panic decisions. Every major downturn has eventually been followed by a recovery. Build for that reality instead of panicking against it. So, should you sell your stocks before a crash? The honest answer, backed by decades of market data and the behavior of the world's most successful long-term investors, is this: most people cannot time it correctly, and trying almost always does more harm than good.